What is the Dodd-Frank Act, and how does it affect mortgages? If you have ever wondered how mortgage lending has changed in recent years, the Dodd-Frank Wall Street Reform and Consumer Protection Act is a key piece of legislation to know about. Enacted in 2010, this law aims to increase oversight and regulation of the financial industry, especially in mortgage lending. It was created in response to the financial crisis of 2000, with the goal of protecting consumers and promoting responsible lending practices. One of the most important aspects of the Dodd-Frank Act is the ability to repay requirement. This means lenders must verify that borrowers can afford to repay their mortgage loans before they can get credit. Lenders look at factors like income, assets, employment status, and credit history. This helps to reduce the chances of default and foreclosure by ensuring borrowers can realistically pay back their loans. The Act also introduced the concept of qualified mortgages. These are loans that meet specific underwriting criteria to ensure safer lending. If a loan qualifies as a qualified mortgage, lenders receive certain legal protections against lawsuits related to the borrower's ability to repay. The criteria for these loans include limits on points and fees, a ban on risky features like negative amortization, and requirements on the length of the loan term. Another key change is the restrictions on how mortgage originators can be compensated. The Dodd-Frank Act prohibits them from receiving payment based on the loan amount or steering borrowers into loans they cannot afford. This helps to promote fairer lending practices and prevents loan officers from pushing borrowers toward higher-cost loans. The Dodd-Frank Act also led to the creation of the Consumer Financial Protection Bureau. This agency is responsible for enforcing federal consumer financial laws, including those related to mortgages. The Bureau oversees banks, credit unions, and other lenders to ensure they comply with mortgage rules, including those about disclosures and loan servicing. Additionally, the Act improved disclosure requirements by combining the Truth in Lending Act and the Real Estate Settlement Procedures Act disclosures into a single, clearer form. This makes it easier for borrowers to understand loan terms and costs before closing. The Dodd-Frank Act also restricts certain loan terms and practices. For example, it bans predatory loan features like yield spread premiums, which are payments to brokers for steering borrowers to higher-cost loans. It also prohibits mandatory arbitration clauses in residential mortgage contracts and limits prepayment penalties. While these regulations may seem burdensome, they aim to reduce risky lending and improve loan quality. Smaller banks and credit unions benefit from some provisions that offer relief, such as special qualified mortgage safe harbors for loans they originate and hold in their portfolios. In practical terms, banks and credit unions must invest in compliance systems and staff training to meet Dodd-Frank mortgage rules. They also need to design loan products that meet qualified mortgage standards and ensure clear communication with borrowers. Overall, the Dodd-Frank Act has reshaped mortgage origination and servicing, emphasizing responsible lending and consumer protection.